30 seconds. That's roughly how long it can take for billions of dollars to move through the global financial system. 30 seconds for markets to react. 30 seconds for algorithms to shift capital. 30 seconds for financial signals to ripple across the world. And in 2026, one of the most powerful forces behind those movements isn't a trader, a banker, or even a government official. It's artificial intelligence. Not the kind of AI people imagine in movies, not robots making dramatic decisions, but quiet systems running inside the institutions that control the flow of money itself. Central banks. These are the institutions responsible for managing inflation, stabilizing economies, and controlling liquidity across entire financial systems. For decades, they relied on economists, historical data, and complex models to guide their decisions. But today, the global economy moves faster than those traditional tools were ever designed to handle. Supply chains stretch across continents. Digital payments move instantly. Financial markets react in milliseconds. Consumer behavior shifts overnight. And because of that speed, central banks are turning to something new. Artificial intelligence. AI systems can process enormous amounts of economic data in real time. They analyze consumer spending patterns, commodity prices, labor markets, lending activity, supply chain disruptions, and market volatility simultaneously. Millions of signals. All at once. The goal is simple in theory. Understand the economy faster and respond before problems spiral out of control. But the deeper impact is far more powerful. Because when AI begins guiding how institutions control inflation and liquidity, it doesn't just observe the economy, it begins to shape it. To understand why that matters, it helps to understand what central banks actually do. Most people think central banks simply adjust interest rates, but interest rates are only one tool in a much larger system. Central banks control how much money flows through the economy. They influence lending, borrowing, investment, and spending. Their policies determine whether credit is easy to access or expensive to obtain. If too much money circulates too quickly, inflation rises, prices increase, living costs climb, savings lose purchasing power. But if central banks restrict money too aggressively, the opposite problem appears. Economic activity slows. Businesses stop investing. Hiring declines. Recessions begin. The challenge is finding balance. For decades, economists relied on models built around unemployment rates, consumer price indexes, and historical economic cycles. But the modern economy has become too complex for those models alone. Global trade disruptions can affect prices within weeks. Energy shocks can ripple through transportation, manufacturing, and food production almost instantly. Investor sentiment can shift overnight based on geopolitical events or market speculation. Traditional economic indicators often arrive weeks or even months after these changes begin. By the time policymakers react, the economic momentum may already be moving in a different direction. Artificial intelligence attempts to close that gap. Instead of waiting for monthly reports, AI systems analyze economic signals as they happen. Shipping data from global ports, real-time consumer spending patterns, commodity price movements, corporate pricing behavior, market liquidity conditions. This approach is sometimes called nowcasting. Rather than predicting the future months ahead, the system estimates what the economy is doing right now. If inflation pressure begins building somewhere in the system, AI can detect it earlier. If consumer demand starts slowing, it can appear in spending data almost immediately. If financial markets begin showing signs of stress, liquidity indicators shift quickly. That early insight gives central banks something incredibly valuable. Time. Time to respond gradually instead of reacting suddenly. Gradual responses tend to stabilize markets. Sudden responses tend to shock them. And in modern financial systems, shocks can spread rapidly. But AI does more than detect inflation signals. It also monitors liquidity across financial markets. Liquidity is the lifeblood of the financial system. It determines whether banks feel comfortable lending money to businesses and consumers. When liquidity is strong, loans are easier to obtain and economic activity expands. When liquidity tightens, credit becomes scarce, and financial systems can stall. During major crises, central banks often inject liquidity into markets to prevent panic. Historically, this meant lowering interest rates or purchasing government bonds to increase the money supply. But today's financial system is far more interconnected than it was even 20 years ago. Liquidity stress can appear suddenly in unexpected places: bond markets, corporate credit markets, short-term funding markets between banks. Artificial intelligence helps monitor these systems continuously. AI models track market volatility, lending behavior, treasury yields, and funding spreads between financial institutions. If unusual patterns begin appearing, such as banks becoming reluctant to lend to one another, the system can detect early warning signs. That detection can give central banks valuable time to intervene before panic spreads. For example, if corporate borrowing costs suddenly spike, businesses might struggle to finance operations. If treasury markets experience extreme volatility, investors could lose confidence in the stability of financial assets. AI systems watch these indicators constantly. When unusual stress patterns emerge, central banks can respond faster than ever before. Sometimes the response involves injecting liquidity. Other times it involves sending signals to financial markets through policy communication. But artificial intelligence also plays another important role: simulation. Before central banks make major decisions, they often test potential outcomes through economic models. Machine learning allows these models to simulate thousands of possible scenarios. What happens if interest rates increase by 0.5%? How might mortgage demand react? How might corporate investment change? What happens to unemployment 6 months later? No model can perfectly predict the future. But AI allows policymakers to analyze probabilities across complex economic environments. Instead of guessing outcomes, they can explore different possibilities before taking action. Yet the system becomes even more complicated when we remember something important. Financial markets themselves are now dominated by algorithms. High-frequency trading firms move billions of dollars within milliseconds. Investment funds use machine learning models to allocate capital. Credit decisions increasingly rely on automated risk systems. In other words, modern finance already operates at machine speed. Central banks introducing AI into policy analysis is partly a response to that reality. If markets move at algorithmic speed, policy institutions must understand those movements just as quickly. But speed introduces new risks. One of the biggest risks is feedback loops. Imagine an AI system detecting rising inflation pressure. Policymakers signal that interest rates might increase. Financial markets react instantly, adjusting bond yields and lending conditions. Those market reactions feed back into economic data. The system then interprets those signals again and updates its predictions. In complex financial ecosystems, these feedback loops can amplify trends quickly. Sometimes they stabilize markets. Other times, they increase volatility. That is why central banks remain cautious about allowing algorithms to make decisions automatically. Human judgment still matters. Policy committees review the outputs generated by AI models. Economists debate whether the signals make sense. Risk analysts test whether predictions match real-world outcomes. Artificial intelligence acts as an advisor, not a decision maker, at least for now. But the amount of insight AI provides into the economy is unprecedented. For the first time in history, central banks can observe economic behavior at enormous scale. Millions of transactions, global financial flows, market movements across multiple asset classes. Instead of reacting to old information, policymakers can observe patterns forming in real time. This level of visibility can make monetary policy more precise. Interest rates can be adjusted earlier. Liquidity support can target specific markets. Economic overheating can be slowed before inflation becomes extreme. Many economists see this as a major improvement. Better data leads to better decisions. Better decisions lead to more stable economies. But others see risks. When machine learning models influence policy insights, transparency becomes harder. Most people already struggle to understand how central banks operate. Adding complex algorithms into the process makes it even more difficult for the public to see how decisions are made. Another concern involves model bias. Artificial intelligence learns from historical data, but the future rarely behaves exactly like the past. Technological innovation changes industries. Consumer behavior evolves. Global economic relationships shift. If models rely too heavily on past patterns, they might misinterpret new developments. Central banks constantly update their models to address this problem. New data enters the system. Predictions adjust. Assumptions evolve. But perhaps the most significant transformation still lies ahead: digital currencies. Many central banks are exploring the development of central bank digital currencies, often called CBDCs. A digital currency issued by a central bank could allow transactions to move through systems directly connected to monetary authorities. If widely adopted, such systems could provide enormous amounts of economic data in real time. Payment flows, spending patterns, regional economic activity. Artificial intelligence combined with digital currency infrastructure could allow central banks to observe the economy with unprecedented clarity. This does not necessarily mean controlling individual transactions, but it would dramatically increase visibility into how money moves. And greater visibility could allow more precise inflation and liquidity management. Of course, this also raises important questions. How much financial visibility should governments have? How transparent should algorithmic policy tools be? How much influence should artificial intelligence hold in monetary decision-making? These debates are only beginning. What is clear is that the relationship between artificial intelligence and central banking will continue expanding. Economic systems are becoming more digital. Financial markets operate faster than ever. Global capital moves across borders instantly. To manage inflation and liquidity in this environment, central banks need tools capable of understanding enormous complexity. Artificial intelligence provides those tools, not as a replacement for economists, but as an amplifier of economic insight. The algorithms analyzing financial signals are not trying to control the economy. They are trying to understand it faster than ever before. Yet as these systems become more powerful, they inevitably influence the decisions that shape financial conditions. And those decisions affect everyone. The interest rate on a mortgage, the cost of financing a business, the stability of banks, the strength of national currencies, the pace of economic growth, all connected to the institutions balancing inflation and liquidity behind the scenes. Artificial intelligence is quietly becoming one of the most important tools those institutions have ever used. Not visible to most people, not often discussed publicly, but increasingly present inside the systems guiding modern monetary policy. The global financial system has always been complex. Now it is becoming intelligent as well. And the way central banks use that intelligence may quietly shape the future of money, markets, and economic stability for decades to come. If you found this breakdown valuable, make sure to like the video, share it with someone interested in the future of global finance, and drop your thoughts in the comments. And if you want more deep insights about AI, global money systems, and the forces shaping the world economy, don't forget to subscribe.